My name is Luis Vasquez, and welcome to today's VC Speaker Series. We're honored today to have Michael Beaudoin, who is the Director of Private Equities for Mark IV Capital, where he directs and manages the company's investments in seed rounds, Series A rounds, Series B rounds, and several funds. Today, we'll have a conversation on his view on the private markets, from venture funds to direct investments. We'll also get an investor's perspective on private company performance during the pandemic and the evolving role of corporate VC. Michael has also done some extensive research as part of the Kaufman Fellows program, so he's going to give us some information about that. So we're glad you're here. As you know, our goal for this webinar series is to continue to connect the Southern California innovation ecosystem with the experts and resources that will help entrepreneurs and founders navigate this current crisis and thrive in the recovery. So before we get started too far, I'd like to acknowledge and thank our sponsor for the VC Speaker Series, Kenobi Martins. They're consistently ranked as one of the top intellectual property firms in the nation and worldwide, and they have close to 275 lawyers and scientists, and they have a dedicated practice to all aspects of intellectual property and technology law, including litigation. The firm is headquartered in Orange County, and we're fortunate to have at UCI Beal Applied Innovation to have Kenobi as strong supporters of our mission and of this VC Speaker Series. So more information can be found at www.kenobi.com. All right, so now a few webinar details. Unlike the many Zoom meetings that you've been on in the last 2.5 months, you can't unmute yourself and you can't turn on your video. So if you have a question, please type the question in the Q&A box, not the chat box. I'll moderate and ask those questions throughout our discussion or at the end of the presentation. And also this presentation is being moderated and recorded. And by next Monday, you can visit our website, innovation.uci.edu, and you can review that the presentation there. And also keep an eye on our emails and our social media channels for information on our next VC Speaker Series webinar. So with that, Michael, do you want to join us now?
Thanks, Luis. Thanks for having me here today.
Great. Our pleasure. So let me turn this off. Okay. And we'll go ahead and get started from there. So Michael, we appreciate you joining us. And why don't you start off by giving us a kind of a brief run through of your academic and professional career kind of before you got to Mark IV.
Thanks. And like I said, thanks again. And I love seeing the UCI Applied Innovation background there. Can't wait to see the new building again after we can rejoin.
Right.
So my quick background, I started in commercial and investment banking, leading mostly wealth management teams and doing a loan origination for commercial middle market companies. And then around 2009, went back to business school and really wanted to focus on really what made mergers work, what made corporate innovation happen. And ultimately ended up in a leadership program for AT&T where I rotated through operations, did an internal merger with about 60,000 employees of combining an omni-channel experience. And then from there went on to a strategy group in political affairs. Okay. And they thought it would be a stretch rotation, had a great idea, was really wondering why were entrepreneurs and VCs constantly testifying against us in Congress and trying to install at the time was the net neutrality. And as we did some research, as strategists do, you come back with an answer and say, it's because we don't participate. We were seen as a tax on the new economy. We were, charging internet connectivity fees and, companies were starting online and that was the lifeblood to their new business. So we had to change that. And generally, we also wouldn't procure things from new companies because if they went out of business, our change costs were way too high. So we're seen as a company that didn't want to innovate, didn't want to work with innovators, and we would only acquire things after they kind of achieved, the topping out of growth.
All right. So what did AT&T do about that?
Yeah, so we ended up building a accelerator and deciding that we could really, if we monitored 16 areas of places where productivity changed and increased because of mostly the iPhone and access to mobility. And the one place where there wasn't a change in productivity was education. And what we found was there really wasn't any investment in education technology from 2008 to 2012 because we'd gone through this dip in the economy And education historically has been funded by nonprofits and grants. So as a recession occurs, one of the first things people stop doing are donating. So we said, well, this isn't right. This is a real business. It's, just like any other business out there. And so we stepped in to start investing in education technology so we could democratize access to education. So how do we use, some of the best facilitators and use these online tools that a lot of universities and school districts have had to resort to in the middle of this virus? But also, how do we find things to make sure every student can learn on their own at the pace that they need to and, achieve a level of education standard?
Okay.
Yeah, so we started investing in seed. We built an accelerator, and part of the idea was how do we bring these best-in-class corporate assets to early-stage companies, which was really difficult, and it was a lot of fun and very rewarding. So when they asked me to go back and manage the team of corporate attorneys, that sounded like a pretty terrible idea. I'd been bitten by the bug. It was supposed to be a 1.5 year rotation, and for a little over 4 years, was able to luckily build and run that accelerator.
Okay. Good.
Yeah.
Good. Is that accelerator still going, by the way?
It is. Actually, I talked to my friend Sandra, who's operating that today for Productive LLC, and not only going strong, it's still a bellwether program, and they're able to really tell stories and help new investments flourish and get out to the schools.
Okay. And obviously now you're at Mark IV Capital. But before we get into Mark IV Capital, this is a question I've asked a lot of our investors here because I know that there are some prospective and folks out in the audience that would like to be venture capitalists or join this. So what advice do you give to people starting their career or earlier in their career that would like to get into venture capital or private equity? It's always such a circuitous path. So, but what advice do you give?
Yeah, I mean, if anybody had asked me if I was going to move into venture capital and private equity, I took the most meandering, strange path. So I'd say there's not a linear path in this industry. It's an emerging, newer industry. Working with entrepreneurs, we just hired actually a new analyst out of UCI on our team. He's doing a fantastic job. He really showed an interest in entrepreneurship. He built a great business plan. So we're able to interact with them through some of the events there at the Cove. But just like any other industry, showing tenacity, working really hard, and just absorbing all the information you can about it.
Cool. All right. So tell us about Mark IV. How did you end up at Mark IV? And then you could just kind of roll into telling us about Mark IV Capital in general.
Yeah, so I was up in the Bay Area operating the accelerator, and if I was looking at a survey, I'm just saying, here are the markets where things are doing well, and AT&T had been a really big supporter of Rise of the Rest. So Steve Case's program that shows that innovation is going to happen all over the place, and while Silicon Valley was a dense first mover, if we looked at markets that were going to be next, Southern California had all of the things to be that were ripe. And I would say too, Silicon Valley's changed quite a bit over the last decade or so. It's one of those things where when your product driven success, you get things like people moving there and traffic and all the things that were kind of detractors to productivity. And we also saw a lot of people hopping jobs. So a lot of people were engineers and trying to create their own mini VC by going to work for places, and their goal is to be there just long enough to have some stock vest, and they kind of move on to the next one. So it becomes really tough to build like a real corporate culture. It's tough to have a team that's dedicated to the success of the company. They're still doing a great job. It is still absolutely one of the places that if you're going to be working in venture, you have to have a presence and understand that companies are going to come from there. But I thought Southern California really showed promise. So it was really started looking between Los Angeles and San Diego, and was fortunate enough that Mark IV took me in.
Oh, wonderful. Okay, so tell us about Mark IV, maybe without the private equity practice. Tell us about the rest of Mark IV so that then we can delve into your stuff.
Yeah, I mean, Mark IV is a boutique asset manager, focuses primarily on commercial real estate and private equity. There's 4 asset managers that manage properties from Austin, Texas to Arizona to Utah. Nevada, Arizona, and northern Southern California. So it's a pretty broad enterprise. And in 2017, they really decided to professionalize the private equity side, and that's when I was hired in to help, look for both direct new investments as well as manage existing and growing venture capital, portfolio.
Why have a private equity practice anyway? I mean, real estate literally pays the rent. It's a good business to be in. So why did Mark IV choose to get into private equity so strongly and professionally?
Yeah, I'll dive into probably a little bit more on the Kaufman sides, but one of the things with private equity, it's an uncorrelated asset class completely. So when we see stock markets move up, stock markets move down, real estate in its cyclical manner, private equity has its own cycles, and we're in the middle of those as well. But they're also just uncorrelated. So it's still an area where there's a lot of wealth creation. There's still a lot of room for growth, and when I look at jobs, for instance, most of the jobs created over the last 20 years were created. If you took out venture capital completely, we'd have almost no job creation in this country. So I'd say it's a passion for most, firms. People started as entrepreneurs, and anyway, the practice, like I said, just also has some great economics behind it.
Yeah. Yeah. So tell us about your private equity strategy then. So what sectors does Mark IV look at, kind of at what stage of development? There's a question in our chat box about is there any focus on life science? So we'll go ahead and knock that question off while you're talking about your sectors.
Yeah, I would say so. We'd look at it as a portfolio, first of all. So there are different sectors. Life science is definitely a core. However, life science, for instance, takes a lot of internal capital to deploy. So that's a good example where it's better to use a dedicated manager who has a team, a track record, PhDs that are focused on the science behind the life sciences. And so we have, some partner with some, venture firms that we invest in directly that kind of covered that space and need for our portfolio. Mm-hmm. And then, generally that's how all of our venture manager selection works. They're covering areas of the portfolio that are either difficult or additive to our ecosystem. So for instance, some managers are higher in the capital stack. So they're primarily focused on Series C, D, E. They're, tied in with firms that can help companies go public. And that's a section of the ecosystem. And then there's other funds, like the Co-Fund is a phenomenal fund that really has a good view of early stage companies between LA and San Diego. And so they're a great fund to work with because, hiring lots of people to watch this area and similar in other geographic areas, becomes very laborious. And so we get some really great information by having some managers who are really, touching the pulse of that really early stage company creation. And then for Mark IV Direct, we look at primarily Series A. We'll generally go a little bit earlier if the companies and the managers are really supportive of the management team and the company is trying to trend the right direction. But for Direct, we really look for companies where either a large corporate or a government is the customer, and they've demonstrated some past success. They've had some revenue, and they're looking to then add capital to help accelerate that revenue into the B and C rounds.
Okay, got it. So direct investments and some fund manager investments on that side. So as far as the fund manager side of things, mm-hmm. You mentioned that you like fund managers that have direct expertise in particular areas, particularly life science. You talked about you like fund managers that have expertise in different parts of the capital stack, kind of Series B, C, and D, et cetera. So it looks like you go about building out your fund manager portfolio in some of the ways like you build out a regular portfolio. You want to make sure you have expertise and coverage in all areas. But one of the things I know you're particularly generous with, I think, your time, is evaluating new fund managers. And so I'm sure there's some folks out there in the audience who dream about being fund managers at some point on their own, so VC fund managers. So what advice would you give to a serial entrepreneur who would dream of starting their own fund? What would it take to get an investment out of Mark IV, or frankly out of all of these other kind of larger allocators that you know?
Yeah, I mean, yeah, I would say, talking more broadly, one is have an opinion. What is there today? Where will the future be going? Why would your strategy help find those companies that are going to grow? And that's, I'd say, for a serial entrepreneur, it's also probably really reliant on their network. So do they grow, two or three, life sciences companies, and they're really known in the industry, and they're being sought out after for advice on how to build companies. So what's that story? Why does your network? Why is there progression? I would say a lot of the managers we support too have had some type of track record of success in that space, or I'd say all of us. It's usually a qualifier. So for an entrepreneur, did they have a large exit? Did they have an outsized exit? Did they have they been consulting with private equity and venture firms and have decided to kind of take this in a more professional full-time role? And do they understand what is the path of growing a company and then ultimately finding that acquirer or path towards IPO?
Okay. Okay. Um, in your role, uh, both kind of out here in the community, and then what you do with meetings and networking events, and the fact that you've been in this industry a while, you probably run into a lot of family offices, for example. And I thought this is a topic we haven't covered yet in any of these webinars. So I wonder if you could tell us a little bit about that for our audience. If maybe you can define and describe what a family office is, and then we'll kind of get into a little bit on the other side of how do you deal with them. So what is a family office?
Yeah, I'll just take this for my Kaufman Fellows. As a Kaufman Fellow, you work on what's called a thought leadership project, and my thought leadership project has been around the surveying of investment preferences for private equity and venture capital among family offices.
Oh,
So
good. Perfect.
we'll test a little bit of my early research here, and I'm finalizing the kind of the full document at this point. But what I see, so first of all, when I define there's a family office, and it's a high net worth or ultra high net worth investor. And the main difference between the two, I'd say, is a family office has hired professionals to manage that on their behalf, where a high net worth investor is somebody who is making those investment decisions themselves and has not, hired a professional to delegate that task to.
Got it.
It's kind of like the main differentiator I kind of use for this research. So, how core is the person that created the wealth, or the family that has the wealth? How active are they in actual distribution? And there's not, let's say, one wrong way or another, but it was just, I needed a linear definition. So going back towards preferences for family offices, what we saw, number one, was this is a very good wealth transfer tool. So, for instance, in the CARES Act, there's interfamily loans that can happen. And with interfamily loans, you want the money to be used and be able to appreciate faster than the loan payback period. And so venture capital is a prime spot where the growth can happen over a long period of time. These loans can happen over a long period of time. And so it helps with estate planning tools. That's kind of one area of it. And that was, I was surprised that was a very large preference by a lot of the family offices I was surveying. The second preference was, most of the time, high net worth individuals in family offices, the wealth originated at some point in time in entrepreneurship. And so the number two reason for family offices that were investing in the space was a strong preference to be closer to entrepreneurs. And I thought that was pretty interesting. So, I think a lot of entrepreneurs kind of approach, family offices as another area to find shareholders and build, and find investors. But they kind of forget that they do have a deep-rooted history in this. If it's not their generation, it's a prior generation that they were very close with.
Okay.
Yeah, so there tends to be some strong sophistication. And then I think the third thing that makes, family offices and high net worths separate than funds is usually they're operating on a much longer time scale. So a fund usually is a pretty regimented 8 to 10 years. The fund will exist, and at the end of the period, it needs to wind down, sell its assets. So there's internal motivations. We talk about funds generally invest over 4 years, harvest over hopefully 4 to 6 years. High net worth individuals and family offices could be looking at multi-generational wealth, as I talked about this kind of estate planning tool. So the time frame's much wider, and they generally are very concerned about the health of the business. Not that VCs aren't, but VCs need a very pocketed return for a shorter period. Where if a business takes 20 years to mature, dividends can be just as great of an exit as a sale.
Okay. So I think, if you're an entrepreneur pitching a family office, I certainly don't think you want to go to them and say, hey, guess what? I've got an even longer term investment for you. So I don't think you mean it in that way. So I'm going to say that notwithstanding, any advice for entrepreneurs when approaching family offices? Is there a difference in the way they should approach or structure their pitch to a family office as compared to a VC fund manager?
No, that's a great point. Generally, what I mean by that is just that they can be different voices around the boardroom.
Oh,
But you're definitely right in the pitch. A family office, going back to that, they've hired a set of professionals to manage the day-to-day operations of the investment. You're going to have a pretty similar pitch that you're going to have to a VC.
okay.
For the high net worth families, it can be a slightly different because there may be some preference based on how they created their wealth too. So life sciences entrepreneur, there may be more of a vendor focus on life sciences. So just like anybody, finding out, what are the preferences of that person, the preferences of that team, before you come in and do the pitch, make sure there is a fit, first of all.
Got it. Got it. Okay, cool. Listen, there's one question, little close to that, so I'll go ahead and get it out there now. So Raj asks in our Q&A, what are your thoughts on incubators and accelerators that are acting as fund managers for early stage companies in life science? So I imagine if we can generalize that a little bit, so an incubator accelerator that maybe raises a fund in addition to what they're doing, kind of the hands-on support, so they've got something to fund that. You like that model? Would you invest in that model, or any thoughts around that?
Yeah, I would say, kind of going back to, what is the focus, who built it? Those models, they're they just have to be very careful about them, right? I mean, we want to make sure that there isn't an incentive to do something else. So, having started an accelerator, you kind of focus and passion on this. So, with our accelerator at AT&T, it was very much outward facing, and we didn't receive any revenues from somebody if they bought a cell phone or needed HR questions, or there wasn't any type of referral fees for professional services related to that entity. So I'd probably get pretty altruistic there, but I think accelerators and all venture firms, one of the keys is they also have a broader view and knowledge. So you know, when you have an employee issue, this isn't the first time they've generally seen it. If you have an investor issue, it's not the first time they've seen it. So I'm a big fan of, they can really help people with the broad-based formation of a business. And if you find one, and we're starting to see a lot more focus on sectors. So if you find a sector focus accelerator too, they can have valuable industry access that would be very difficult for you to get on your own. But yeah, like I said, there's been some other models in the past around Orange County and other places where there's been this kind of all in one, we're going to manage every other part of your business, including finding talent and doing all these things are really core to a business that, we just want to make sure the entrepreneur has a grasp on, because they're still the owner of that business no matter what.
Yeah.
The owner of the operations of that business.
Yeah, good advice. So a question in our chat box also kind of leads into another area that we're going to talk about. So Venkat wants to know if COVID affected angels and VCs' interest or ability to invest in new projects, and any specific input related to Orange County and kind of the local area's ability to still make investments. And I know you and I were going to talk about this anyway, and so you actually surprised me with one of your answers about what's been going on during the pandemic. So why don't we talk first of all? In your thoughts, do you think the pandemic has affected investors' ability to invest?
Yeah, I'll take that apart in a couple different slides, and I also have a slide. We'll kind of talk this a little bit later, but I'd say one, the CARES Act and the PPP really seem to extend the runway dramatically of some of these companies. So when back in October or back in March and April, I was expecting a little bit more panicked calls, and looking for, and dropping valuations and kind of all things that were anticipated coming into this that never materialized.
Mhm.
Um, and I think part of this has been explained, with the government funding and aid. I think part of it also is PE firms, and so venture capital and private equity, I'm going to lump them into one, are extraordinarily well capitalized. They have more dry powder on hand than almost any other year in history right now. So it's still an ultra competitive environment. And so the competition is what's going to drive valuation there. We did see on the earlier stage, and a trend starting in 18 that really showed a decline in the quantity of early stage transactions being done in this market and some of the markets that we kind of lump together that we survey. So it's Southern California, Boulder, Colorado, Austin, Texas, kind of our main spots. I think part of that is just the willingness to deploy risk capital at this point in the economic cycle. And so we did see some downtrend there, but the trend line did not change through COVID so far.
Right, right. I've mentioned this before in some of my others, but and some of the other webinars. But in dealing with a large network of VCs and kind of professional investors, as you described, I noticed about 5% of them specifically came back to me and said, "We're pausing right now." And but it's been long enough that I'm starting to reach back. And I'd said of the ones that paused, half of them have started again, and half of them are still holding off. So yeah, there is some concern, but really not that many. As to kind of your point, there's a lot of dry powder. The CARES Act seemed to help. Initially, there was a lot of concern. Oh my goodness, we've got to watch everybody's cash amounts. We've got to watch their runway. We've got to slash costs, which they did, which were right things to do. But maybe just because of those things, didn't quite see the dip that they were concerned about. So definitely seeing things kind of pick up a little bit. But is who knows? I mean, I notice you've got some. I've seen some stock movements there on the right. So yesterday's volatility shows that we're certainly not out of the woods yet when it comes to volatility, and valuations in private markets do tend to follow those other valuations. So I think why don't you tell us about what kind of some positive results that you guys at least have seen. So you guys have had some good exits actually during this pandemic. Is that right?
We've had about 3 exits so far, which once again just demonstrates this is a completely uncorrelated asset class. Actually, one of the exits, I think at UCI, was LAS, and it shows it was mechanical. We got an FDA approval, and now this merger is going through, and it had been on the table, and shows it didn't matter if it was in the middle of a pandemic or not.
Right.
So that was outstanding, and we have another company that was sold in an all cash transaction to Thomson Reuters. And so, that even shows I understand biotech is always very separate, which is another reason we hire very brilliant professional managers to handle that space. But on the other side, on the traditional and corporate M&A front, we think that all cash transactions would dry up almost immediately, and this happened a few weeks right into the pandemic. So there was still an ability to take risk. The pricing was almost unaffected, and it was great to see.
Okay, so it hasn't been all a matter of the opportunistic on the side of the strategics. I mean, of course, they're a little opportunistic, but it sounds like there was a little bit of opportunistic, but a little bit of strategic as well. And the time is right. The milestones have been hit. So let's just go ahead and let's execute this deal.
Yeah. I mean, a matter of fact, one of our other portfolio companies saw an Italian-based investment from a publicly traded entity in the middle of this as well. So, a local Lisa Viejo-based company had an investment publicly known now from Datalogic. It was a 5-figure transaction. It was, phenomenal to see this go through in a very, very difficult environment for both those entities. But ultimately, innovation and the growth of these companies is gonna keep moving on. So I can't let these things kind of stumble.
Right, right. Hey, I think now's probably a good time to go into the slides. So why don't we grab some of those? Let me start our screen share again, and we'll have you go through some of these slides. All right, so we've kind of got it up here. So once again, a little bit of background on the Kauffman Fellows Research Program over, and then kind of what you've done, and then we can walk through this.
Yeah, so the Kauffman Fellows Program it's a 2-year fellowship for experienced venture capitalists, and through those 2 years, one of the things you work on is what's called, like, as I mentioned, the Thought Leader Project. And so the research coming from the Kauffman Fellows group is usually professionally aimed. So the audience is usually venture capital managers. So as I mentioned, my focus is a little bit more on family offices and what's their motivation for investing in venture and private equity. But for instance, this slide was really talking about the trends. So if we see, why is there wealth creation happening? What is this phenomena we've seen as venture capital? And where I'm going to really drive down with this, venture capital has really started to replace what used to be small cap equity. And we're seeing companies stay private longer. We're seeing the benefits to staying private longer, that they can have more time to focus on growth and not be worried about the quarterly reporting that we see. And, frankly, the burdensome reporting that can be a cash drain for a company that's accelerating growth rapidly. So they're now, especially after 2008-9, there's been enough money and shift to the private equity markets that these companies can sustain themselves longer before needing to go into the public markets. So as a result, we've seen the average IPO price increase dramatically. And I'll in a couple other slides, I'll get a little clearer on what I mean by that. And while we did see this kind of tick back in 2018, the long-term trend line, we see dips and deviations from it, but the trend line is still increasing, maybe plateauing, but still going to be dramatically higher than it has been at any point in history.
Okay.
And so as a result of keeping the companies private longer and understanding what is going to be a marketable transaction in the public markets. So a great example of this would be like Zoom, where it was a well-received IPO. From the IPO, there was a lot of liquidity, there was an increase in price. And now we've seen the company really take hold in the public markets and move upward, as it's been received well by investors and has done phenomenal, of course, during COVID. So it's been a good management team to execute, but they had more time to stay private. They IPO'd at a larger realm. So we're seeing the average price and the average valuation dramatically move up as well. So supply is also constrained because companies are staying private longer. Higher quality companies are the ones IPOing nowadays. So we're also seeing more demand for those companies. And, there's really, as put my portfolio manager hat on, there really aren't that many other places to go right now. I mean, if we go to long-term bonds, if, I kind of use the analogy of being a banker in Tokyo, where do you place money globally? Well, if I put it into a Euro bond, I get a negative yield. If I go into US Treasuries, depending on exchange rates, we could see a negative yield there too. So U.S. private public markets are still, a great place for growth and long-term, wealth creation.
Right, and then from a private equity point, you can capture some of this growth if you're in the private equity side even before they get to that public side. So it makes a lot of sense.
Yeah, and as I mentioned, we know that companies are becoming bigger. We know what the public markets want. We want to make sure those prices are supported. So public companies are staying private longer. And we see this if you look at just the IPOs of Microsoft and Google. Microsoft IPO, for every dollar invested, is about $126 returned. For Google, for every dollar invested in the IPO, there's been about $15 returned. And it's because Google was private equity and venture backed much longer and was able to obtain a lot of its growth before going public.
Mm-hmm.
So as a result, other than the last few days, we've actually seen a lot less volatility in the public markets than we've seen historically. So better supply, better companies leads to better investor confidence there. and we've shifted the growth and the high caliber portion of the growth curve to private equities.
Okay, makes sense.
And so even though we know and we've watched Shark Tank and we've seen this growth happen in the venture capital world, one thing is we've also transferred the risk. So if we look at 61% of all dollars invested, or all companies that were invested in, actually had a 0 to 1x return. So what this graph is really ultimately leading to is manager selection is incredibly important. So there's been a lot of these storied companies in this 1.49%, but it is not the norm return. And hopefully we can bump the norm between that that 1x to 5x, or really that 3x to 7x is a real kind of sweet spot in the risk return model. And that's one reason if companies make it to a Series A, they're more likely to be kind of in that realm. Because there's a lot less risk and fallout there. But overall, there's phenomenal returns, but it's really important to have strong manager selection, strong selection bias, which is why everybody says there's so much money in all these companies and all these PE firms and all this dry powder sitting there. Why can I not get my business plan funded? And it's still a competitive marketplace. There's still lots of competition to be funded. There's lots of people looking at, business plans, and there's still selection bias going on.
Right, right, yeah. So lots of dry powder, but it's still, if you've got very high thresholds to be considered, if you've got to clear a very high bar to actually get some of that dry powder that's out there, it doesn't behoove them to lower those standards simply to deploy some of that capital. That makes sense.
That's right. This is what I was alluding to. So this is the, I call it Southern California, Denver, Austin transactions. And one thing we've also seen is a rapid decline since 2018 in the quantity of transactions performed. So this is where we're seeing probably a lot less, actually a lot of it was Series A activity. We found a real void there. We still found a robust seed economy, especially in those three markets. There's a lot of entrepreneurs. There's a lot of ultra high net worth individuals. TCA I think is extraordinarily powerful here. It's a TCA and also tech, and it's the Angel Network, Austin Angel Network, doing a great job helping entrepreneurs tackle those key early hurdles. There's also been some strong accelerators, whether it's Wayfinder, Evo Nexus, Octane, and some other ones down in San Diego as well, or Austin Capital Factories got a storied past. So we're still seeing a lot of activity, but we're also seeing more concentrated transactions. So we're seeing some of these companies too are just raising larger Series B and Series C in these markets. So it's very positive for their local economies. Those tend to be like big changes and catalysts for hiring when you're going from a 15 to 25 person organization to maybe a 100-person organization. So it's really good for their economic development. But as a result, we have seen the quantity of transactions decrease, but the amount of money going into those transactions has also gone up. I think we've also seen seed transactions really move from what might have been $300,000 to $500,000 in a transaction to be all of a sudden $2 to $3 million tends to be, a more common number in a seed transaction. So we've seen kind of the whole capital stack shift up.
Right. Interesting.
Things that used to be seed are now Series A. Things are Series A now used to be Series B, and all the way across.
Okay. From a regional perspective here to a kind of a global perspective. So.
Yeah, and from a global perspective, it's just why venture capital. As I mentioned, there's really been a replacement of what used to be small cap equity growth, has shifted back into private markets. But at the end of the day, COVID aside, world economic issues, various issues throughout different countries, we're still seeing world population growth. We're still seeing new tech innovations. We're still seeing, wealth creation in the private capital markets. And so, private equity and venture capital is really, I think, here to stay. This isn't something that's going to be displaced, but we're starting to see more replication now in other countries, in other markets. We're starting to see that spread. And so that is not only the spread of the wealth creation, but it's also a spread of job creation. So we're definitely starting to see more people grasp and understand entrepreneurship.
Sure. I mean, and this might be, almost, I don't want to make this sound kind of just oversimplistic, but venture capital now has been through a lot of crises and a lot of cycles, right? Since it kind of took off in the 80s and 90s with structural changes, frankly, at the beginning of in the middle of the 80s. If you think about all the different crises that have gone through, if the dot-com burst, or the Great Recession, or now what's going on here, it didn't, isn't going to kill private equity. It's an asset class that's here to stay. And, there'll be cycles within it, of course, but it really is something that, as you said, relates to job creation now going globally. It's a very important area. So you touched on this a little bit earlier. So let's wrap up with a few more questions. We got a handful of questions in the chat box I want to make sure we get to as well. But you talked a little bit about the Bay Area and kind of what motivated you personally to look towards Southern California and then do a kind of targeted approach, and you ended up kind of working down here as well. But what's your view kind of right now, Bay Area versus Southern California? And then we'll talk about some of the other regions that Mark IV is interested in. So how about that first comparison?
Yeah, I would say I'm a huge advocate for Southern California, and we have the right mix of strong university talent. We have that, I always call it kind of the artist lifestyle, where we have scenery, we have access to recreation. I know while we complain about our traffic woes down here, the Bay Area is, it's really becoming difficult to get anywhere during the day. So that had become kind of a strong issue, and the cost of housing there has become astronomically high, as we've seen. So while we have some of those similar issues down here in Southern California, it's just not quite as it's not quite an impediment to daily life. We have great access to international markets. We have phenomenal airports. And all these things really do give Southern California a real leg up in attracting new entrepreneurs and a talent to work in those companies. And talent's always the lifeblood to all these companies that are being built. As you mentioned, entrepreneurship is spreading, right? I mean, you don't have to, if you're Spotify, you don't have to leave Finland and come to the Bay Area to get a Series A and then stay there and grow your company anymore. I think also the Bay Area will not lose its dominance. So if you think of like Manhattan as the center for global equity trading and banking in general, we'll still see the Bay Area as a stronghold for venture growth, but it's really easy for venture capitalists to even fly down here and participate in transactions. And it's easier to get here than other places, even Austin. It's far enough away that it's just a little more difficult to get there. So with strong access to capital, strong access to talent, it's a great place to support a business.
Wonderful. What do we need to do better though? So put on your critical hat. What does Orange County need to do well or better than it's doing now?
I think rewarding our talent. We shouldn't look at somebody and say, there's been a position in the past, I think this is starting to change, which I'm a little hesitant on it, but we used to say, engineering talent down here is 20 or 30% cheaper than the Bay Area. Well, if I'm a graduate, I don't want to hear that. I want to go to the place where I'm getting the highest paycheck, and yes, I'll deal with some strife up there for some interim period, and I may want to come back down here. And by the way, we're seeing that trend happen quite a bit. People that have had some experience at startup companies, they're coming down here now to kind of form their permanent companies. But I think that delta for cost of talent, kind of drives that top talent to go wherever they're going to earn the most. And I think if we're starting to change that motivation, we're now on parity. It'll help make sure we have the right talent here.
Okay.
Yeah, and I think telling the story, this is the best place to start a company.
Got it. Okay, cool. Let's grab some of these other questions that have kind of popped in here. So Mike Hill wants to know, what skills do you believe are the most valuable for students to have to increase their success of their startup? So student startups or young people, what are the valuable skills they need to have?
Yeah, one, interpersonal skills are very, very important. I mean, you're talking to investors, you're hiring employees, you're trying to motivate them, you're building out a structure, and you're helping them all understand the vision that you've had. So those are all very different relationships, and being able to manage those relationships is really, really important. Um, yeah, other than that, I think the typical technical skills, do you have the engineering background? Do you have the finance background to make sure a company is going to be successful?
Okay. So a few more questions that were prompted by our family office discussion. One is that if, I'll paraphrase, if VCs are hard to get in front of, family offices are even harder. So how do you open those doors? How do you kind of get in front of a family office? And then I think we answered this one. It's about family offices. Do family offices have a defined time frame to an exit, or are they more focused on the long term? I believe you answered that, and you said they may be more focused on the long term, but still as equally or more focused on the business fundamentals. So why don't you get to the first one about how do you find access to these?
That is a great question. I really still don't know. Yeah, a lot of family offices were set up for the anonymity of the families, and that's a really important part. But they are difficult to get in front of. They're different, and I say this because a lot of people in Coffin Fellows are fundraising. They love access to these great family office networks, but they frankly just don't exist.
Yeah.
So a lot of it is, working in, shoulder to shoulder in transactions, developing those relationships, working with universities like UCI that may know, various capital providers. But I really wouldn't differentiate family offices or VCs. They're both going to be difficult to get in front of, and, making sure that people are doing transactions in your space. So I think like PitchBook and CB Insights, those are some great resources now to understand, who's active and
Right.
focus on who's active. And I wouldn't worry about the definition of the two.
Right. And another source is talking to your other entrepreneurs and and understanding, kind of sharing those networks, who's in there. The warm introductions matter a lot. So if there's someone that you value and you respect their opinion, odds are someone else is going to respect that as well. So Abir asks an interesting question. I think it's related to your discussion about the number of deals going down, and that could be that seed investments are getting larger. So so what about kind of the pre-seed then? So who's filling the gap on pre-seed investments in the 250,000 to 500,000 range? What are you seeing out there about who's making those investments sub 500,000?
There is a wide range of people, I think, in those spaces. Anybody from, economic development corporations, because a lot of municipalities have, focused on trying to help incubate companies. We're starting to see, a lot of corporations are making, like AT&T. It was, very early stage. It was your initial, probably first institutional $100,000 check. So, keeping an eye out for, corporations you can work with, and do they have formalized programs yet? And, using resources, like Wayfinder and other things that UCI or venture networks may have, the angel networks, just because the seed rounds are going up, it's still great to start those relationships early. You never know, you may resonate with some of the individuals in the room. And, one of the companies, for instance, we're invested with, they made a pitch to a venture capital firm. They said, there's absolutely no way our firm can make an investment, but what you said resonated, and that manager just personally wrote a check into the company. And it's turned into a great company. So you never know. Pitch everyone.
I think that's angel investors are it's a great thing to look at the subtleties of it. True, some as a whole, maybe angels have moved up, or if risk and volatility goes up, maybe angels will think about being more conservative and looking at deals that are a little bit closer to revenue or that area. But that doesn't mean that it's not a monolithic group. You know, there may still be individuals within that larger group who are going to be attractive to a particular deal, maybe because of their own experience, their own insights. So I think that that having that access, the fact that Tech Coast Angel started here, it's still one of the most active angel groups in the country, and there's chapters all around Southern California now. I think it's a great asset here for us, and even in other areas, life science angels, and you know, it's really done quite a bit for the innovation area. One last question here on your thoughts, because we haven't touched this. What are your thoughts on clean tech? And kind of specifically around pollution and waste issues. Any interest from Mark IV in that space, or do you have managers that are interested in clean tech and waste, you know, waste minimization?
Yeah, I'm actually one of the advisors for San Diego Clean Tech. It would, so clean tech needs to follow every other business, right? There has to be a problem that people are willing to pay for to solve that problem. And so clean tech often kind of flow between a traditional venture capital all the way to a philanthropic mission. And so because there's a wide spectrum, it's really important there to make sure you understand what is your business case, what is your business model, who are your customers, and go forward on what does that business really look like. And so make sure you're talking to the right audience, because like that wide spectrum also does not tend to cross paths very often. But yeah, clean tech, there's going to be innovation. It's really important for society as a whole. There's going to be outsized returns. We've seen some great companies already form into the clean tech groups.
Good, good. Well, I think that's a good place to start wrapping it up. So, Michael, I really want to thank you for participating today and sharing your time and your insight. It's been a great conversation. And listen, I'd also like to thank you, and please pass this on to the entire team at Mark IV. The firm's been a great supporter of UCIBL Applied Innovation, and Mark IV, you know, has really been a bold investor here in Orange County companies. And the ecosystem is much better for having Mark IV here for what, 46 years, I think is on that website. So yeah, you're not new to this, and the ecosystem is much better, I think, because of that. So really appreciate that. So with that, let's go ahead and kind of finish up here. And Michael's LinkedIn information is right there on the board. We'd also like to thank again Kenobi Martins, where you'll find a unique intersection of technical intelligence and legal acumen for a world powered by innovation. And a reminder that the recording of this webinar, and actually, you know, Michael, we didn't talk about that. Those slides, are we gonna, will people be able to see a copy of those slides?
No, I think just through the webinar and being able to talk to them, but yeah, probably not publish them individually.
That's fine. They'll wait for the published research report when it's available, so you get a little preview there. We appreciate you sharing that very much. So, but the recording will be available on our website, which is innovation.uci.edu, and you can look for the weekly webinars under the events tab. So I think with that, thank you everyone for spending some time with us. Keep an eye on your emails and on our social media channels. You'll see a few more of these. These are not going away. We're cutting down our cadence a little bit, you may have noticed. So we're not doing them weekly anymore, but you'll definitely be aware of these webinars as they come up. So with that, everyone be safe and be healthy. Thanks so much.
Thank you.